In this video, we'll dive into 3 crucial topics that every investor needs to know. First, we'll be unpacking President Trump's recent tariff actions. You'll understand the driving forces behind his bold moves and how they impact the global economy. Next, we'll explore smart investment vehicles for a bear market. Discover the top strategies to safeguard and even grow your portfolio during market downturns. Lastly, we'll delve into investing in both bear and bull markets. Learn how to pinpoint the right sectors for maximizing returns no matter which direction the market is moving. Stay tuned. These insights could shape your next big investment move. In April 2025, President Donald Trump initiated a series of unprecedented tariffs affecting imports from numerous countries, including a substantial 104% levy on Chinese goods. This bold move has sparked global economic debates and raised questions about the underlying motivations. Several key factors appear to have driven this aggressive trade strategy. First, addressing trade imbalances. A central impetus for the tariffs is the desire to rectify perceived trade imbalances. The U.S. has consistently recorded substantial trade deficits, particularly with nations like China. By imposing tariffs, the Trump administration aims to reduce these deficits, encouraging a shift towards more balanced trade relationships. This approach seeks to pressure trading partners into negotiating terms that are more favorable to U.S. interests. Second, countering unfair trade practices. The administration has expressed concerns over practices deemed detrimental to fair trade, such as intellectual property theft, forced technology transfers, and market access restrictions. The tariffs are positioned as a strategic response to these issues, aiming to compel countries like China to reform policies that are viewed as harmful to U.S. economic interests. Third, revitalizing domestic manufacturing. A significant goal of the tariffs is to rejuvenate U.S. manufacturing industries that have faced decline due to foreign competition and offshoring. By making imported goods more expensive, the administration hopes to level the playing field for American manufacturers, encouraging domestic production and job creation within the manufacturing sector. Fourth, leveraging trade as a geopolitical tool. Beyond economic considerations, tariffs are also employed as instruments of foreign policy. The administration views trade measures as leverage to achieve broader geopolitical objectives, such as influencing the behavior of rival nations and asserting U.S. dominance in global economic affairs. This perspective aligns with a more assertive approach to international relations, where economic tools are used to project power and influence. Fifth, responding to domestic political pressures. Domestically, there is significant political support for protectionist measures, particularly among constituencies that feel disadvantaged by globalization and trade policies of the past. The administration's tariff strategy resonates with voters who perceive such measures as protective of American jobs and industries, thereby bolstering political support. Sixth, signaling a shift from globalization. The tariffs also symbolize a departure from the era of hyper-globalization that has characterized much of the post-World War II economic order. By imposing trade barriers, the administration signals a re-evaluation of global trade norms and a move towards policies that prioritize national interests over multinational agreements. Seventh, responding to national security concerns. Certain tariffs are justified on national security grounds, particularly those targeting imports like steel and aluminum. The administration argues that reliance on foreign sources for these critical materials compromises U.S. national security, and tariffs are a means to bolster domestic production capabilities deemed essential for defense. Investing in bear and bull markets requires identifying the right sectors. Investing in the stock market can be a rewarding yet challenging endeavor. One of the most critical aspects of successful investing is recognizing which sectors to focus on during different market conditions. In this article, we will explore which sectors tend to perform well during a bear market, a market characterized by declining stock prices, and a bull market, a market characterized by rising stock prices. Understanding these dynamics can help investors make more informed decisions about where to allocate their funds, mitigate risks, and potentially maximize returns. So, what is a bear market? A bear market is generally defined as a market in which stock prices fall by 20% or more from their most recent high, typically lasting for a prolonged period. Bear markets are often associated with widespread economic downturns or recessions, though they can occur in isolated sectors or markets due to external factors. During bear markets, pessimism is widespread, consumer confidence declines, and there is often a general sense of uncertainty. Investors tend to become risk-averse, shifting their focus to safer assets such as bonds or cash. As a result, stock prices fall across multiple sectors, though the extent of declines can vary. What is a bull market? A bull market, in contrast, is characterized by rising stock prices, often spurred by strong economic growth, low unemployment, or investor optimism. Bull markets can last for months or even years, and they are often fueled by increased demand for goods and services, positive earnings reports, and favorable economic conditions. Investors become more confident during bull markets, willing to take on more risk in pursuit of higher returns. As a result, stock prices generally increase, and sectors that benefit from strong economic growth, higher demand, and consumer confidence tend to perform well. Sectors to invest in during a bear market. While bear markets present challenges for investors, some sectors are better positioned to weather the storm. During periods of economic uncertainty or market declines, defensive sectors generally provide more stability and even potential growth. Below are the sectors that tend to perform better during bear markets. Utilities. Why invest in utilities during a bear market? Stability and predictability. The utilities sector is considered one of the most defensive sectors in a bear market. This is because utility companies provide essential services like water, electricity, and natural gas, which people continue to need regardless of the economic climate. These companies often have predictable earnings, which helps them maintain stock price stability. Dividend yields. Utility companies typically pay attractive dividends, which provide investors with a steady stream of income even when stock prices are falling. In a bear market, this can be especially appealing, as investors look for safer, income-generating investments. Examples of utility companies: Duke Energy, Dominion Energy, and NextEra Energy. Consumer staples. Why invest in consumer staples during a bear market? Essential products. Consumer staples include companies that produce essential goods such as food, beverages, and household products. During a bear market, consumers may cut back on discretionary spending, but they will still need essential products to maintain their daily lives. Steady demand. Companies in this sector generally see steady demand for their products even during tough economic times. These companies are often less vulnerable to downturns in consumer spending, which makes them a more reliable investment during a bear market. Examples of consumer staples companies: Procter & Gamble, Coca-Cola, and Walmart. Healthcare. Why invest in healthcare during a bear market? Non-cyclical demand. The healthcare sector benefits from non-cyclical demand, meaning people will always need medical services and products, regardless of economic conditions. Pharmaceutical companies, hospitals, and health insurance providers continue to perform well even in a recession. Aging population. Additionally, an aging population and rising global health concerns ensure that the demand for healthcare services continues to grow over time. Examples of healthcare companies: Johnson & Johnson, Pfizer, and United Health Group. Telecommunications. Why invest in telecommunications during a bear market? Constant demand for communication. The telecommunications sector provides services that are essential for daily life, including phone services, internet access, and wireless communication. People continue to use mobile phones and internet services even when budgets are tight, making this sector relatively stable in bear markets. Strong dividends. Many telecommunications companies offer strong dividends, which can provide income during periods of market decline. Examples of telecommunications companies: Verizon Communications, AT&T, and T-Mobile US. Gold and precious metals. Why invest in gold during a bear market? Well, there are a few reasons. First, safe haven assets. In times of market uncertainty, many investors flock to precious metals such as gold as a safe haven investment. Gold tends to hold its value or even increase in price when other assets like stocks are declining. Next, inflation hedge. Gold is also seen as a hedge against inflation, which can be a concern during economic downturns. Some examples of gold investment include Spider Gold Shares, Newmont Corporation, and Barrick Gold Corporation. Sectors to invest in during a bull market. In a bull market, the focus shifts to sectors that benefit from strong economic growth, increased consumer spending, and rising demand for goods and services. The following sectors tend to perform well in a bull market. Technology. Why invest in technology during a bull market? Firstly, innovation and growth. The technology sector is one of the primary drivers of growth during a bull market. As the economy expands, businesses and consumers increase their demand for innovative products and services, from cloud computing to artificial intelligence and mobile devices. Secondly, high growth potential. Tech companies tend to offer high growth potential, as they often benefit from increased demand for their products and services, as well as their ability to scale quickly and expand into new markets. Some examples of technology companies are Apple, Microsoft, and Nvidia. Consumer discretionary. Why invest in consumer discretionary during a bull market? Increased spending. Consumer discretionary companies provide goods and services that are not essential, but are desired by consumers, such as luxury items, automobiles, and entertainment. During a bull market, consumers tend to spend more on these non-essential items, leading to higher revenues for companies in this sector. Rising confidence. A strong economy and rising consumer confidence drive demand for consumer discretionary goods and services, making this sector a prime beneficiary of bull markets. Examples of consumer discretionary companies: Amazon, Tesla, and Home Depot. Financials. Why invest in financials during a bull market? Increased lending and investment. The financial sector thrives in a bull market, as higher economic growth leads to increased lending, borrowing, and investment. Banks and financial institutions benefit from low interest rates and high demand for loans, mortgages, and credit. Strong earnings. As the economy expands, financial institutions see stronger earnings from their core businesses, such as asset management, banking, and investment services. Examples of financial companies: JP Chase, Bank of America, and Goldman Sachs. Industrials. Why invest in industrials during a bull market? Rising demand for infrastructure and goods. The industrial sector benefits from increased economic activity, as businesses and governments spend more on infrastructure projects, manufacturing, and transportation. This sector performs well when demand for goods and services rises, and when supply chains become more efficient. Positive economic indicators. A growing economy leads to more demand for industrial products and services, which boosts the earnings of companies in this sector. Examples of industrial companies: Caterpillar, Boeing, and General Electric. Real estate. Why invest in real estate during a bull market? Well, rising property values play a significant role. In a bull market, rising consumer confidence and economic growth increase demand for housing and commercial properties. As property values rise, real estate companies and real estate investment trusts, or REITs, benefit from higher rents, property sales, and capital appreciation. Additionally, low interest rates are often seen during bull markets. These lower rates make it cheaper to borrow money for real estate investments, leading to more demand for both residential and commercial properties. Some examples of real estate companies to consider include Prologis, Simon Property Group, and Public Storage. Investment vehicles for a bear market: strategies for protecting and growing your portfolio. Inverse ETFs, profiting from declining markets. Inverse exchange-traded funds, or ETFs, are designed to move in the opposite direction of the index or sector they track. These ETFs use derivatives to achieve their inverse performance, making them a popular choice for investors looking to profit from market declines. So, how do they work? If the S&P 500 drops by 1%, an inverse ETF like ProShares Short S&P 500 will ideally rise by 1%. Some inverse ETFs are also leveraged, amplifying returns by 2 times or 3 times, such as ProShares Ultrashort S and P500. These are best for active traders who want to capitalize on short-term downturns without shorting individual stocks. Defensive stocks are shares of companies that tend to be less sensitive to economic cycles. These sectors, such as utilities, consumer staples, and healthcare, provide products and services that people continue to use regardless of economic conditions, offering relative stability during bear markets. Examples include companies like Coca-Cola, Procter & Gamble, and Johnson & Johnson, which sell everyday products and are often seen as safe havens. Defensive stocks are best for long-term investors seeking stability and consistent dividends during market downturns. Dividend-paying stocks offer investors regular payouts, which can be especially attractive when capital appreciation is slow or negative. These stocks tend to perform better during bear markets because they provide income even when the underlying stock price declines. Investing in well-established companies with a history of paying reliable dividends can provide a steady income stream, mitigating some of the losses from price depreciation. Dividend-paying stocks are best for income-focused investors who want to generate cash flow while holding through a bear market. Bonds, particularly treasury bonds and high-quality corporate bonds, are often viewed as a safe haven during bear markets because they tend to perform better when stocks are down. U.S. Treasury bonds in particular are considered among the safest investments as they are backed by the U.S. government. Types of bonds include government bonds like U.S. Treasuries, which are low risk and offer fixed interest, corporate bonds, which are issued by companies and offer higher yields than government bonds, but come with slightly more risk, and municipal bonds, which are issued by local governments and can provide tax-free income for investors. Bonds are best for conservative investors seeking capital preservation and steady income during periods of market volatility. Precious metals like gold and silver have long been used as a hedge against economic instability and inflation. During bear markets, especially when triggered by economic factors like high inflation, precious metals can act as a store of value. As the value of currencies and stocks decline, the price of gold often rises. Gold ETFs, such as Spider Gold shares or investing directly in physical gold, are popular ways to gain exposure to the metal. This is best for investors seeking a traditional store of value that tends to appreciate during economic turbulence. Cash and cash equivalents, liquidity and safety. Although holding cash during a bear market may not generate returns, it provides liquidity and safety. Money market funds or high-yield savings accounts can offer a low-risk way to preserve capital while waiting for better opportunities in the market. While cash in a savings account or money market fund may earn a modest interest rate, it remains highly liquid and safe, offering peace of mind during uncertain times. This is best for risk-averse investors who want to maintain flexibility and avoid market losses during a prolonged downturn. Alternative investments diversification beyond traditional assets. For more sophisticated investors, alternative investments such as real estate or private equity can provide diversification and opportunities for return during a bear market. These assets often have low correlations with traditional stock and bond markets, helping to balance risk. Real estate can provide steady rental income and appreciation, while private equity investments may offer high returns in the long run, especially if public markets underperform. This is best for investors seeking diversification and long-term growth potential beyond traditional market assets. To find out more, visit us at uiemployees.com.